To build a long-term, wealth-growing portfolio, many investors agree on one point: start with a solid foundation. A key strategy is diversification, and one of the simplest methods to diversify right away is through ETFs, exchange-traded funds. ETFs let you own part of many different stocks, sometimes in the hundreds or thousands. In this video, we'll dive into one of the top dividend ETFs. At the end, we'll compare it with other well-known ETFs to determine if it's the better choice. We'll examine the Vanguard Dividend Appreciation ETF, VIG, and compare with the popular SCHD, which is the Schwab US Dividend Equity ETF. The Vanguard Dividend Appreciation ETF, VIG, stands as the market's largest dividend-focused ETF, boasting an impressive $66 billion in assets under management. This positions it among the top 20 largest ETFs in the market. Over the past year, VIG has seen a 13% increase in share price, slightly lagging behind the S&P 500's 18% rise. Historically, VIG has closely mirrored the S&P 500's performance, as evident in the comparative charts, showing only a 5% difference in total returns. This correlation with the S&P 500 suggests a significant exposure to the technology sector, especially given the sector's prominent role in 2023's market dynamics. Analyzing VIG's sector allocation reveals technology as its predominant area, constituting about 23% of the ETF. This is followed by financials, healthcare, industrials, and consumer defensive sectors, collectively account for 81% of VIG's composition. The ETF's top holdings include major players like Microsoft, Apple, ExxonMobil, United Health Group, and JP Morgan, among others. These top 10 companies represent about 31% of the fund, which overall comprises 318 positions. Delving into VIG's top 3 holdings, Microsoft, Apple, and ExxonMobil provides insight into the fund's valuation. While analyzing just 3 companies doesn't fully encapsulate the ETF's overall valuation, it offers a glimpse into individual stock valuations. For instance, Microsoft's forward price-to-earnings P/E ratio stands at 28.8, slightly below its 5-year average, indicating a potentially fair value. Apple appears slightly overvalued based on its P/E ratio, and ExxonMobil presents as undervalued compared to its historical average. VIG, established in 2006 by Vanguard, aims to replicate the performance of the S&P US Dividend Growers Index. This index tracks companies known for consistently increasing their dividends. Investors in VIG currently enjoy a 2% dividend yield, which has grown annually by nearly 10% over the past 5 years, with a track record of 9 consecutive years of dividend growth. This ETF not only offers an avenue for steady income, but also reflects a strategy focused on dividend growth and stability. Now, let's turn our attention to another significant dividend ETF, the Schwab US Dividend Equity ETF, commonly known as SCHD. This ETF has rapidly grown in popularity and is arguably one of the top dividend ETFs in the market. While it doesn't quite match VIG in size, with $47.5 billion in assets under management, SCHD is close to surpassing VYM, poised to become the second largest dividend-focused ETF after VIG. Over the last year, SCHD's performance has seen a modest 5% increase, but this is somewhat atypical. Historically, SCHD has frequently outperformed the S&P 500, although in the last 12 months, the S&P 500 has edged out SCHD by about 1% over a 5-year period. This slight underperformance is notable and might be attributed to SCHD's sector allocation. SCHD's diverse portfolio is led by industrials, healthcare, financials, consumer defensive, and then technology, which ranks 5th in sector exposure. This allocation is significant in understanding SCHD's recent underperformance, particularly in a year where technology and communication services sectors led market gains. SCHD's lesser exposure to these sectors, especially technology, is a key factor here. Looking at SCHD's top holdings, it's a mix that includes Amgen, AbbVie, Chevron, Merck, PepsiCo, Broadcom, Verizon Communications, Coca-Cola, Texas Instruments, and Cisco Systems. These top 10 account for 40% of the ETF, which in total holds 104 positions. Notably, only a few of these top holdings are in the technology sector. When we delve into the valuation of SCHD's top 3 holdings, Amgen, AbbVie, and Chevron, we find some interesting trends. Amgen, trading at a forward P/E multiple below its 5-year average, appears undervalued. AbbVie, however, might be slightly overvalued when compared to its historical average, and Chevron seems undervalued based on its current forward P/E ratio. SCHD is unique in its dividend approach. It's not categorized by a high-yield dividend ETF, yet its yield is relatively high compared to others like HDV or VYM. Currently, SCHD offers a 3.7% dividend yield, with a robust 5-year dividend growth rate of nearly 14% and consistent growth over 11 years. VIG is an excellent ETF, better than NOBL for investing in reliable dividend stocks. It's a top choice and expected to return about 12% in the long run, which is better than both the S&P and the average aristocrat ETFs. If you're into dividend aristocrat investing, VIG is a really good option. It's like the best of the best in this category. However, right now, SCHD is the better pick. It gives almost double the yield of VIG and is expected to grow faster. This could mean a lot more income over the next 30 years, adjusted for inflation. SCHD's past performance shows its strategy works well, thanks to its strict criteria for choosing stocks. In the long run, it could give 3 times the total returns compared to other options. Its value is also better. SCHD's stocks are 25% undervalued, compared to VIG's 13%. While VIG has a good price-to-earnings ratio, P/E ratio, SCHD's is even lower. Compared to the S&P 500 and NASDAQ, VIG is a good deal, but SCHD is an even better deal with a very attractive valuation. SCHD's potential return over 10 years looks great, with a 3.7% yield and a 10.5% growth rate. It could potentially return 17.1% annually. That's 385% compared to 135% for the S&P 500. Getting a nearly 4% safe yield that grows fast and is 25% cheaper is a great opportunity. So while VIG is a solid choice for dividend ETFs, SCHD is currently one of the best options for long-term income growth investors. As we wrap up this video, let's summarize the key secrets of dividend ETF investing we've uncovered today. Remember, the world of dividend ETFs is vast, but knowing how to navigate it can significantly boost your investment strategy. Firstly, understanding the composition and sector exposure of each ETF is crucial. ETFs like VIG and SCHD have different sector allocations, which can impact their performance, especially in varying market conditions. Secondly, don't just look at the dividend yield. Consider the growth potential and historical performance of the ETF. A higher yield might be attractive, but long-term growth and stability are equally important. Thirdly, valuation matters. An ETF trading at a discount or at a more favorable P/E ratio can offer better long-term value. SCHD, for example, stands out in this regard. Lastly, always align your ETF's choice with your investment goals and risk tolerance. While SCHD currently may seem like a better option for many, VIG's consistent performance and stability make it a reliable choice for conservative investors. Thanks for joining me in exploring the secrets of dividend ETFs. If you found this video helpful, please like and subscribe for more insights. And don't forget to share your thoughts and questions in the comments section. Until next time, happy investing and stay savvy in your pursuit of the best dividend ETFs.